The S&P 500 hit new record highs, gaining close to 9% year to date. Since March of 2023, it's up over 30%. All this while, other indices around the world are also hitting all-time highs. For example, Europe is hitting all-time highs, while countries like Germany are almost in recession. At the same time, Japan is also hitting an all-time high after 34 years. These levels were last seen in 1989. Even emerging markets like India are seeing an all-time high in March. And don't forget that Bitcoin is up over 200% in the last year. If you want Bitcoin specific information, check out my last video. Some are surprised by what happened in 23 and what's still happening, while some of us who have tracked markets closely have profited from this rise. Now you could be curious why the markets are up, or you just need a refresher on what's going on. In this video, let's look at the factors that are contributing to the crazy market movements. Let's begin. Let's look at some macro factors first. The S&P 500 has surged over 40% from its October 22 low to hit a new all-time high. This powerful move has been fueled by a convergence of different macro factors. Firstly, the market was set up for a strong rebound after the brutal bear market of 2022 that saw the S&P 500 plunge 27%. Historically, some of the strongest bull markets follow after such steep declines. This is because stocks need to recover from their oversold levels. Towards the end of 22, S&P 500 was around 3,800, down around 18% for the year. But even by the end of Jan 23, the index had already rallied 6.18% to cross over $4,000. For a lot of people, this marked the start of a new bull market. The other thing that has been thrown around a lot is the word recession. Despite the widespread recession fears, the US economy has proven surprisingly resilient. The GDP growth has been accelerating. For the full year of 23, real GDP increased 2.5%, exceeding expectations. This surprised a lot of people, but it helped build investor confidence. Consumer spending has also remained solid with a backdrop of strong labor market. The unemployment rate was just 3.9% in February 24, near historic lows. This economic strength also paved the way for good company profits. The other thing that goes hand in hand with recession is inflation. Inflation, which surged to a 40-year high of 9% in June 22, has steadily moderated. The latest CPI data shows prices rising at a more tolerable 3.2%. The Fed's preferred gauge, the core PCE inflation, has also tamed down. As we know, as the inflation started coming down, Fed stopped raising interest rates. This came after multiple aggressive rate hikes, some of the fastest we have ever seen. This year, the talk is all about rate cuts, and only time will tell what the Fed will do. But always remember, markets are always forward looking, and that's why the prices keep going up. Looking at some more data, as of March 13, 2024, the S&P 500 trades well over 5,100, up 32% from a year ago. And that's about 9% year to date. At current levels, it's trading at a forward PE ratio of around 20, above the 25-year average of 16.8. But this is well below the peak of 24.1 in September 2020. So even though the markets feel extremely rich, it's actually not that overvalued. I would say it is becoming rather overheated, and in the coming weeks and months, I'm expecting a pullback of around 6 to 12%. Moving on, let's look at some other factors. While macro has been supportive, the strong rally in 23 was propelled by few companies and market-specific catalysts. As we know, leading the charge were the most popular tech giants, also known as the Mag 7. The move started with Apple, Microsoft, Google, Amazon, Nvidia, Meta, and Tesla. These companies accounted for an outsized portion of the S&P 500 gains. Before talking more, yes, I know that Tesla has fallen behind, and as of today, it's one of the worst performing stocks in the S&P 500. Personally, I'm just accumulating the stock right now. Comment below if you hold the stock or if you're buying right now. Anyway, going back to the 7 stocks, they returned an average of 111% in 2023 versus 25% for the S&P 500. They accounted for 29% of the S&P 500's market cap at the start of 2024, an all-time high concentration. As we know, excitement around AI was a major catalyst. Of course, this is especially true for Nvidia. Unbelievable. In total, the Mag 7 have a now combined market cap of over $10 trillion, making up over 25% of the entire S&P 500 valuation. While these companies led the initial surge, the rally has now broadened quite significantly. Cyclical sectors like industrials, materials, financials, and consumer discretionary are now participating as the economy proves resilient. A broader advance like this signals a healthy bull market. The equal weighted S&P 500 index, which gives equal weighting to all 500 stocks regardless of their size, has also caught up to the S&P 500 over the last few months. This just means that the rally has now broadened and is no longer relying on a handful of stocks. In other words, it's becoming a little easier to be a stock picker again. Another thing we must talk about is investor sentiment. All this rise in the market has greatly improved investor sentiment, providing more fuel for the market's rally. The CNN Fear and Greed Index, which measures market sentiment on a scale of 0 extreme fear to 100 extreme greed, has risen from around 25 in October 22 to currently reading 69 indicating elevated levels of greed. The money flow shows that investors are moving out of bonds and cash and into stocks and other assets. This also comes as recession fears fade away. The American Association of Individual Investors survey shows bullish sentiment climbing from 20% last year. By the way, it's still not at very elevated levels. This improving sentiment also reflects increasing risk appetite. But please be careful out there. By the way, there's another reason for such a strong move, and it's much stronger than expected earnings. The impressive numbers help justify relatively elevated valuations. Earnings is a big topic in itself and is probably for another video. In this video, I wanted to introduce a couple more topics that indicate that 2024 will likely see stocks, Bitcoin, real estate, and overall markets going up further. One key driver is the simple fact that 2024 is a presidential election year. Historically, stocks have tended to perform well in election years, especially when an incumbent president is running for a second term as Biden is. If we look at some of the numbers, 83% of the time there was a positive outcome for the S&P 500. Overall, just glancing at the table, you can tell that the odds are in your favor. The combination of increased government spending, investor optimism around policy continuity, and campaigns putting a positive spin on economic data typically provides a tailwind for markets. If you're an investor, don't worry about who's winning, just focus on your returns, which are likely going to be great this year. Another intriguing factor for more upside potential is the 18.6-year real estate cycle theory. Sometimes considered a controversial idea, this theory states that real estate values tend to follow a recurring cycle of approximately 18.6 years. If the theory holds true, we are in the second half of this current 18.6-year cycle. The second half of the cycle from years 4 to 9 has historically seen the strongest price appreciation across real estate, stocks, and other asset classes. This is also popularly known as the winner's curse. While the theory is not certain, it certainly aligns with the current market momentum. If it does play out, we will see the prices of assets rise extremely fast over the next couple of years, followed by a massive crash in the second half of this decade. This is something I'm still studying, and I highly recommend looking at Jason Pizzino's content to learn more about these two topics. He covers them quite regularly. Also, in general, I've learned a lot from his channel. With that, I have covered most of the things that I wanted to cover in this video. Keep an eye out for a pullback in the coming weeks and months. I believe any pullbacks here are buying opportunities, but be careful, stay away from hype and FOMO. I will see you next week with a new video. Till then, keep learning and stay on top of your finances. Until next time.